Us, Leigh. I wanted to touch on Greece, which has approved some austerity measures of late and looks poised to get a further bailout when it meets with EU finance ministers. But the IMF, on the other hand, believes it should get some sort of debt relief in the interests of sustainability. What's your take on this issue?
Thanks for having me, Nampu. I think the biggest discord is definitely between Germany and the IMF itself. I think we're going to see some kind of accord in the next sort of 24 to 48 hours, and Greece is going to be waiting on some kind of debt relief to be pushed through to tomorrow. But what it really does entail is the IMF taking part as a part of that 86 billion euro bailout. But part and parcel of that discussion is the fact that Germany's maybe got to be a bit more lenient with some of the austerity measures that have been put in place, and look at extended periods in which the payoff can be done by Greece. And they're pretty much taxing everything from coffee all the way through to luxury goods. So it really is going to be quite a tight conversation on really what do Greeks own in Greece over the next sort of 99 years as certain products are put under lease, are put under curatorship. And that's really where the pinch points are for the IMF and in particular Germany and the EU at this stage.
Obviously, a major overriding factor in the markets right now is what the US Fed will do. And I see that there is an expectation, a 50% probability, that's what the markets are saying, that the US Fed will raise interest rates in June. What are the implications for emerging market economies like South Africa?
Well, it's interesting, you know, up until 4 weeks ago, they were only factoring in about an 8% hike in June. And now suddenly that the Fed has come out after the recent jobs numbers and wage inflation numbers, and Lockhart and other members of the Fed are being a little bit more hawkish on potential raises, that now the market is factoring in a 50% raise in interest rates. They always have said it's a live meeting. The implications for us obviously are if the dollar does start to rise on the raise in interest rates, it can hurt us. As we've seen, the rand has weakened over the last sort of 2 to 3 weeks. That will be good for some of the industrials and some of the rand hedge players, and we only need 5 or 10 of those to prop up the top 40, and our index can even make gains on the back of that. For the consumer, it makes it a lot tighter, and I think we've seen the guidance from Pioneer Foods and the likes of Tiger Brands in their results stating that it's going to be a lot tougher for the consumer going forward.
So let's stick with that, since you've now touched on to the corporates. Tiger Brands reporting 14% increase in half-year earnings, and Pioneer Foods also talking about the difficult terrain with consumers. Just spell out some of the challenges that they have going forward and whether those are the kind of stocks one would be confident to invest in.
I don't think it comes down to as much confidence as it is about timing. I think, you know, when we look at results now, we're looking at the previous year's results based on the previous year's sales and revenue generation. However, with the onset of the drought and with the rand devaluing as much as it has against the US dollar, we've definitely seen massive pressures. I mean, a 90% increase in raw material costs for Tiger Brands on the likes of white maize. Now, what that means is that at some stage that has to go to the end consumer. That's not something that a company is going to be able to absorb on a continuous basis. So we might find, you know, with their guidance in the next year or two, that some of these companies are going to come under a little bit of pressure. That's not to say that they're not generating revenue from other places. Rhodes Food Group had a stunning set of results. Tiger Brands and Pioneer actually did fairly well. However, they have said that the forward guidance is going to be a little bit more challenging, and it's effectively for investors. I think it's more a case of batten down the hatches. I don't think it's necessary to go and sell out of any of your shares in these companies. They're good quality, well-run companies, and they certainly have good businesses in other places aside from South Africa.
All right, now, one analyst from one of the big local banks has suggested that, in fact, local equity and bond markets may not have fully factored in a credit sovereign downgrade, which may happen in about 10 days' time, when Standard & Poor's will give its verdict on the country. To what extent do you think there has been a factoring of a downgrade or not? And if the downgrade does happen, what's it going to mean? I mean, are we going to see a massive sell-off on equities and bonds? And what does that mean to people's general wealth?
I would have thought up until recently the contrary actually would have stood, with us effectively pricing in what was a foregone conclusion with the state of the rand, with the allegations against Praveen Gordhan, and really the state of our economy. However, if you look at some of the PMI numbers, if you look at some of the consumer numbers, if you look at some of the economic indicators that have come out recently, they've actually been slightly more positive. Government has been engaging very well with private business. Our deficit has decreased. There was a stage where the rand actually did increase in value, and it was only over this last 2 weeks that the rand's actually started to climb back to those highs that we've seen again. So it may very well be the case that perhaps the IMF, or in particular the ratings agencies, the Fitches and the Moody's and the S&P, look at us and go, well, do you know what, maybe now we're actually taking the steps to right the wrongs that have taken place in the last sort of 3 to 5 years that have led us to this. However, from an investment point of view, it's not something that I would discount. I would look at it and not necessarily look at a fire sale. If you look at our banks in particular, which will be largely exposed to the sovereign downgrade, we're well capitalized. When you look at how the banks are run, we actually prescribe to higher liquidity ratios than a lot of our European and US counterparts. So that's really something that you need to consider. And it's certainly not a place, given the PEs that the banks are trading on, and they're really, really good value at the moment. It's not a place I'd be considering maybe selling my shares. But then you've also got to consider your investment horizon. Are you looking at a 2 to 5 year plan when you're holding physical equities in these? Are they a part of your investment portfolio? Unless you're a trader and you're looking for volatility, it's not something I'd be looking to completely bail out of. The insecurity of the current moment is the biggest issue, and the volatility that's going to come with it. And I think you've just really got to manage your positions carefully and make sure that you're not too overexposed. You might want to trim them up, but I don't think it's necessary to go and have a complete fire sale of all your assets in those categories.
All right, Leigh, I think that's pretty solid advice on your part. Thank you very much for your time. That was Leigh Riley. He's from IG South Africa. After the break, more business.